A retired postal employee in Ohio checked his mailbox in late February of 2026 and discovered a letter from the Internal Revenue Service. He was 71 years of age, had completed 30 years of federal employment, and he had handled everything correctly, or at least that is what he believed. He had withdrawn his required minimum distribution in December. He had submitted his Medicare premiums punctually, and he had completed his tax returns every single year without exception. The letter indicated he was liable for $947 in underpayment penalties. Not taxes he had overlooked, not fraud, not an examination, a penalty for not remitting enough of his taxes at the correct intervals during the year. And the detail that should infuriate you is that nobody had ever informed him this regulation existed. Now multiply that experience by 4.7 million. That is the quantity of penalty notifications the Internal Revenue Service is projected to deliver to retirees and near retirees this filing season. 4.7 million Americans who settled their taxes completely, who submitted on schedule, who followed everything their accountant or tax software instructed them to do, and they are still being charged with a penalty that averages several hundred per household, and in certain situations considerably more than that. The error that postal employee committed and the error millions of retirees are committing right now is entirely correctable. It requires one form, one phone call, or one afternoon with your December required minimum distribution. And once you comprehend how the framework truly operates, you will never incur this penalty again. Here is what transpired, and here's precisely how you guarantee it never happens to you. This video is intended for educational purposes exclusively and is not tax or financial guidance. Speak with a qualified professional before making any choices about your individual circumstances. Here is the fundamental issue, and I need you to grasp it before we examine the stories, because once you comprehend the mechanism, everything else falls into position. The American tax system is a pay-as-you-earn system. The Internal Revenue Service does not wish to wait until April 15th to gather what you owe. They expect it throughout the year in approximately equal portions as you earn or receive income. When you held a regular position, your employer managed this automatically. Every 2 weeks, they deducted money from your paycheck and forwarded it to the agency on your behalf. You never needed to consider it. You never needed to complete a form. You never needed to send a check to the government in the middle of July. Then you retired. The paycheck ceased. The automatic withholding ceased. And now you have a pension or Social Security or required minimum distributions from your individual retirement account or some combination of all three. And none of those income sources automatically withholds the correct amount of federal tax unless you explicitly direct them to. The Internal Revenue Service did not deliver you a letter explaining this transition. Your previous employer did not caution you. Your tax software processed your return accurately and then moved along. And so millions of retirees arrive at the end of the year, owe taxes on income they collected all year long, submit one check in April, and then get charged with an underpayment penalty on top of it because the agency expected that money distributed across the calendar, not surrendered in one lump at the conclusion. The penalty itself is computed under Internal Revenue Code Section 6-654, and the rate is not insignificant. The underpayment penalty rate for 2026 is linked to the federal short-term interest rate plus 3 percentage points, which positions it at approximately 8% annualized on whatever sum was underpaid, for however long it was underpaid on a $15,000 or underpayment, which is not an uncommon amount for a retiree with a pension, a Social Security benefit, and a required minimum distribution all flowing in throughout the year. The penalty can readily surpass $900. On a $30,000 underpayment, the penalty can exceed $1,800. And I need you to absorb that for a moment, because this is not a penalty for cheating. This is not a penalty for concealing income or filing late. This is a penalty for remitting the correct amount of tax at the incorrect time. That distinction carries enormous significance because it means the solution is completely within your control. And the Internal Revenue Service itself has embedded several tools into the tax code to allow you to eliminate this penalty entirely before it ever surfaces on your return. Scenario 1. Carol is 68 years of age. She is a retired public school educator from Illinois with a state pension that provides her $42,000 per year. Her husband passed away 2 years ago, and she now files as a single taxpayer. She also receives Social Security retirement benefits of $22,800 per year, and her accountant assisted her in rolling her late husband's individual retirement account into her own, which now holds a balance of $280,000. When Carol reaches age 73, I am advancing the timeline forward to show you the complete picture. She will be obligated to take a required minimum distribution of roughly $12,000 from that account. All combined, her gross income for the year will be in the vicinity of $63,000 once you account for the provisional income formula that establishes how much of her Social Security benefit is taxable. Her federal tax obligation comes out to approximately $700. Carol had always simply submitted a check in April because that is what her accountant instructed her to do. In April of 2026, she submitted that check and then received a second notification for $480 in underpayment penalties. She contacted her accountant, who apologized and explained the regulation for the first time. Nobody had informed her about it in the 4 years since she retired. $480 vanished for following the guidance she had been provided. Here is what Carol could have done alternatively, and I will walk through the precise mechanics in the action checklist in a few minutes. But the brief version is this. If Carol had filed a Form W-4V, that is, the voluntary withholding request to the Social Security Administration, she could have directed them to withhold 10, 12, 22, or 22% of each monthly benefit check and transmit it directly to the Internal Revenue Service on her behalf. That withholding would have covered a substantial portion of her annual tax obligation in a spread-out continuous way throughout the calendar year. She could have also reached out to her Illinois pension administrator and filed a withholding election to deduct taxes from each pension payment. Most public pension systems offer this option, and most retirees never inquire about it. Complete both of those steps, and Carol's underpayment penalty would have been zero. Same income, same tax obligation, different delivery schedule, same input, different output. One costs her $480, the other costs her nothing. Scenario 2. This one involves a man I will refer to as Robert. Robert is 74 years of age, a retired firefighter from Texas, and he is one of the individuals you might assume is most shielded from this issue because Texas has no state income tax. And because Robert has been conscientiously making quarterly estimated payments every year since he retired, his pension from the municipality where he served for 28 years provides $61,000 per year. He is not yet collecting Social Security because of the government pension offset, but that is a separate discussion. Robert also has a rollover individual retirement account with a balance of $450,000, and he has been taking required minimum distributions for 2 years. His required minimum distribution for 2025 was approximately $18,000, up from $14,000 the prior year, because his account balance had grown. His federal taxable income after the standard deduction for a single filer over 65, which in 2026 is roughly $16,350, came to approximately $61,650. His federal tax obligation was around $9,200. Robert had been calculating his quarterly payments based on the prior year's income, which was lower because his required minimum distribution amount had not yet escalated. His quarterly payments totaled $7,200. That left a deficit of $2,000 against his actual obligation. The penalty on that underpayment, computed quarter by quarter at the applicable rate, came to approximately $500. Robert cannot determine what went wrong. He submitted his payments on schedule. He did everything he was supposed to do. The answer is that his income increased when his required minimum distributions grew, and he never went back to recalculate his quarterly payments to keep pace. That is one of the most frequent traps I observe, and I am going to return to the solution in the checklist. Scenario 3, this one is the counterintuitive one. So pay careful attention, because this is the scenario that astonished even individuals who believe they have this mastered. Patricia is 67 years of age. She is a retired hospital administrator from Minnesota. She has a pension of $48,000 per year, a Social Security benefit of $31,200 per year, and she is not yet obligated to take required minimum distributions because she does not reach 73 until 2032. Patricia is exceptionally organized. She submits quarterly estimated payments every single year. She utilizes tax software to determine her estimated amounts. In 2025, she remitted $3,100 per quarter, $12,400 total across all four payments. Her actual federal tax obligation for the year came to $12,800. She overpaid by $300. No underpayment, no issue, correct? But here is where the trap activates. In the third quarter of 2025, Patricia had a medical crisis. She fell behind on administrative tasks. She missed her September 15th estimated payment completely. She recovered in October and transmitted a double payment, $6,200, to balance herself for the year. But here is what Patricia did not realize. The Internal Revenue Service computes the underpayment penalty quarter by quarter, independently, and it does not care that you overpaid in a separate quarter to compensate. You cannot recover a missed quarterly payment by doubling the subsequent one. The penalty had already accumulated on the September 15th underpayment from the instant that deadline passed until the day her October payment arrived. Even though Patricia remitted more than her total tax obligation for the entire year, she still owed an underpayment penalty of roughly $42 because one quarterly installment arrived late. $42 is not catastrophic, but it is $42 she should not have paid. And more significantly, it revealed to Patricia just how mechanical and unforgiving this penalty framework is. The agency does not contact you to announce a deadline is approaching. It does not transmit a warning letter. It just computes and charges, and it does not care that you are in the hospital. Scenario 4. Now, here is the approach that transforms everything for retirees who take required minimum distributions. And this is the strategy that the finest retirement tax planners employ, and that almost nobody in mainstream financial media discusses. Meet Gerald. Gerald is 76 years of age, a retired federal employee from Pennsylvania. He has a pension of $38,000 per year, a Social Security benefit of $26,400 per year, and a required minimum distribution from his individual retirement account of $4,600 per year. His estimated total federal tax obligation for 2025 is approximately $10,800. Gerald does not want to manage quarterly estimated payments. He finds the framework bewildering. He is concerned about making an error like Patricia did. He wants a straightforward solution. Can Gerald circumvent the underpayment penalty without ever transmitting a quarterly estimated check? The answer is yes. And the mechanism is one of the most potent and underutilized tools in the retirement tax toolkit. Gerald directs his individual retirement account custodian to withhold a specific dollar amount from his required minimum distribution as federal tax withholding. He waits until December, maintains his money working in his account all year long, and then in mid-December he takes his full required minimum distribution and instructs his custodian to withhold $10,800, which is his full estimated federal tax obligation for the year. That money gets transmitted directly to the Internal Revenue Service. Now, here is the elegant part, and this is the regulation that makes this entire approach function. Under the tax code, federal income tax that is withheld at the source, meaning withheld from an actual payment, not submitted as a quarterly estimated check, is treated as if it were remitted evenly throughout the entire year, regardless of when it was actually withheld. The law does not state December withholding counts only for December. It states withholding counts as if it occurred evenly across all 4 quarters. So if Gerald withholds $10,800 in December, the Internal Revenue Service treats that as if he had remitted $2,700 on April 15th, $2,500 on June 15th, $2,700 on September 15th, and $2,700 on January 15th of the following year. All 4 quarterly deadlines fully satisfied with a single instruction given in December. Gerald gets to retain all of his money working in his account from January through mid-December. He incurs 0 underpayment penalty. He submits 0 quarterly checks. He places 0 phone calls to the agency. He simply informs his custodian what to do in November, and it is resolved. Same tax obligation as Carol. Same income picture as Robert. Zero penalty. That is not a loophole. That is the statute. And the Internal Revenue Service is not going to contact you to clarify it, but I am explaining it right now. Now, here is where it becomes essential, and this is the portion of the video I want you to bookmark or document because most individuals, including honestly many tax preparers who are not specialists in retirement income, do not have a comprehensive picture of all three shields that exist against the underpayment penalty. You only need one of them to apply to be fully protected. The first shield is the current year safe harbor. Under Internal Revenue Code Section 6654, you are completely penalty-free if the total of your withholding and your estimated payments equals at least 90% of your current year actual tax obligation. That means if your tax bill this year turns out to be $15,000 and you remitted at least $13,500 throughout the year. In a combination of withholding and quarterly payments, you owe no penalty. The second shield is the prior year safe harbor. And this one is simpler to utilize because you already know precisely what your prior year tax was. It is on last year's form, 1040, line 24. If your total withholding and estimated payments this year equal 100% of your prior year tax obligation, you owe no penalty, regardless of how much more you owe this year. For higher income taxpayers, specifically those with a prior year adjusted gross income above $150,000, the prior year safe harbor rises to 110% rather than 100%. So if your adjusted gross income last year was $200,000 and your tax obligation was $22,000, you need to remit at least $24,200 this year, 110% of last year's obligation, to utilize the prior year safe harbor. These two safe harbors together mean that if you remain in contact with your prior year return, you will almost never owe an underpayment penalty, even if your income increases substantially. The third shield is the one almost nobody is aware of, Form 2210, the underpayment of estimated tax by individuals and fiduciaries. This form accomplishes two things. First, it permits you to annualize your income, meaning the penalty computation is performed based on when your income was actually received, not distributed evenly across 4 quarters as if you earned it at a consistent rate. This is essential if you took a large required minimum distribution or Roth conversion in the 4th quarter, if you sold an investment property in November, or if any of your income was significantly front or backloaded during the year. Using the annualization method in Part 2 of Form 2210 will frequently reduce or eliminate a penalty that would otherwise appear automatically on your return. Second, Form 2210 contains a specific waiver provision for retirees. If you are 62 or older and you retired or became disabled during the tax year or the prior tax year, and you can demonstrate that the underpayment was due to reasonable cause and not willful neglect, the agency can dismiss the penalty entirely. This is a narrow waiver. It does not apply to every circumstance, and it requires documentation, but it is legitimate. It is in the statute, and millions of recently retired Americans who would qualify for it have never heard it referenced by their tax preparer. Here is your action checklist, and I am going to provide you 10 concrete things you can do right now. 1. Open your most recent Form 1040 and locate your total tax on line 24. Write that number down. That is your baseline. That is what you need to match this year at a minimum to qualify for the prior year safe harbor. 2. If you receive Social Security benefits, go to ssa.gov or call 1-800-772-1213 and request Form W4V, which is the voluntary withholding request. Choose a withholding rate of 10, 12, 22, or 22%. Pick whichever percentage, when multiplied by your annual Social Security benefit, comes closest to covering your share of the estimated tax obligation. This change typically takes 6 to 8 weeks to take effect, so do not wait until December to begin this process. 3. Contact your pension administrator, whether that is your state's retirement system, a former private employer, or if you are a federal employee, the Office of Personnel Management, and ask to file a withholding election on your monthly pension payments. Nearly every pension system permits this. Ask specifically for the withholding election form and make sure your election goes into effect before the next calendar year. 4. If you are already taking required minimum distributions from an individual retirement account and you want to use the year-end withholding approach I described in Gerald's scenario, contact your individual retirement account custodian no later than mid-November and inform them in writing that you plan to take your required minimum distribution in December and that you want to withhold a specific dollar amount for federal taxes. Calculate that dollar amount against your prior year's safe harbor figure so you know precisely how much to have withheld. 5. If you make quarterly estimated payments, mark all 4 deadlines in your calendar right now: April 15th, June 15th, September 15th, and January 15th of the following year. Do not attempt to compensate for a missed payment by doubling the next one. The penalty occurs the moment a quarterly deadline passes with an underpayment, and adding money later does not cancel what has already accumulated. 6. If your income increased this year compared to last year because of a larger required minimum distribution, a Roth conversion, a pension cost of living adjustment, a part-time position, or unexpected investment distributions, recalculate your quarterly payment amounts immediately. Use your prior year tax obligation as the absolute floor, and adjust upward if you know this year's income will be meaningfully higher. 7. If you had uneven income this year, a large lump sum distribution in the fourth quarter, a property sale in November, an inherited individual retirement account distribution late in the year, instruct your tax preparer to complete Form 2210 and use the annualization method in Part 2 when they file your return. In many situations, annualizing your income under the actual receipt schedule will reduce your calculated penalty to 0 or near 0, even if your total annual income was substantially higher than last year. 8. If you turned 62 or older and you retired or became disabled in 2025 or 2024, specifically ask your tax preparer about the reasonable cause waiver that is available on Form 2210. Direct them to the form instructions which describe the waiver for retired and disabled individuals. Do not assume your preparer will raise this unprompted. Many will not. 9. Before you choose how much to withhold from a required minimum distribution, or how large a distribution to take in a given year, check whether the extra income would push your modified adjusted gross income above the income-related monthly adjustment amount thresholds for Medicare Part B and Part D. As of 2026, those surcharge amounts kick in when your income as a single filer exceeds approximately $17,000, and they can add several hundred to several thousand per year to your Medicare costs. A distribution approach that saves you from a $900 underpayment penalty is not worth it if it costs you $1,800 in Medicare surcharges. Run both numbers. 10. Do not depend on your tax software to alert you about the underpayment penalty before it happens. Tax software computes and reports the penalty at filing time after it is already too late to prevent it. Put a recurring reminder in your phone or calendar for mid-October of every year. Use that reminder to review your year-to-date income from every source. Estimate your full-year tax obligation and compare that to what has already been withheld or remitted in quarterly installments. That one annual review done in October when you still have time to make adjustments is worth more than any single form or phone call. Let me place one final dollar amount on this, so the stakes are entirely transparent. The Internal Revenue Service is projecting 4.7 million penalty notifications to retirees in this filing cycle. The average penalty in recent years has run between $400 and $800 per household. At the low end, that is roughly $1.9 billion in penalties collected from American retirees who did nothing wrong except remit the correct amount of taxes at the incorrect time. $1.9 billion extracted from individuals who worked 30 and 40 years paid into this framework, their entire careers, and who are now being penalized for not understanding a regulation that no government agency ever sat down and explained to them. Many of those households have adjusted gross incomes under $50,000 per year. This is not a tax on wealthy individuals. This is a penalty falling disproportionately on retired educators, retired firefighters, retired postal employees, retired nurses, individuals who have limited room in their budgets to absorb surprise charges they did not earn. You are not going to be one of those 4.7 million. The safe harbor regulations are in Internal Revenue Code, Section 6, Sengoda 54. The withholding treated as evenly distributed regulation has been the statute for decades. Form 2210 has existed in substantially its current form for a long time. Form W4V is sitting on the Social Security Administration's website right now waiting for you to download it. These tools are in the tax code specifically because Congress recognized that the transition into retirement creates withholding gaps, and they chose to give retirees a set of legal mechanisms to bridge those gaps without penalty. Your county property records office has your name and address. They have never once transmitted you a letter explaining those tools. The Internal Revenue Service has never contacted you to explain them either. That is why this information matters so much right now. If this video assisted you, hit the like button right now. It takes 1 second, and it helps this video reach more retirees who need to hear it. If you are not subscribed yet, hit subscribe and turn on the bell so you do not miss the next one. If you know a retiree who has been filing faithfully every year without ever setting up withholding on their Social Security check or their pension payment, and there are millions of them sitting one missed quarterly deadline away from a penalty notification, send them this video today. It could save them several hundred this very filing season. And before you leave, I want to pose you one question. Have you ever received an underpayment penalty notification from the Internal Revenue Service? Leave a comment below and share what year it happened and how much it was for. I review every single one, and the most common questions become future videos. I will see you in the next one.